Welcome to the eCom Collab Club podcast, where operators, risk takers, and battle-tested founders drop the lessons that cost them time, money, and their sanity, and share what actually works so you don't have to pay the same price. Hosted by Peter Garderner and Adam Pearce, founders of the eCom Collab Club and Blend Commerce, the Shopify CRO agency, and proudly sponsored by OmniSend. Email and SMS marketing so good, it's boring.
Hello guys, it's Adam Pearce here, co-founder of eCom Collab Club and Blend Commerce. Now guys, I'm flying solo today, and that means I won't keep interrupting Peter every time I get excited. So I suppose at least that's a bonus. But anyway, on today's show, guys, we are getting into the topic of finance. And now, frankly, I know this scares the shit out of most of you when it comes to even knowing where to start, or even kind of, where to start looking for some of the options. So what I wanted to do is get someone on the show today to break it down, help you understand the when, the why, the how of financing for your e-commerce brand. And the person who's going to do this is Blake Ball, who's a director of Finspire Finance, and you're going to meet him right after this.
Do you sell stuff online? Then you need OmniSend. Yes, that OmniSend. The powerful yet refreshingly intuitive email and SMS tool that helps you make $73 on average for every dollar spent. Like watching steady lines go up and up and up? Just automate your email and SMS campaigns with OmniSend. Set it up once, then sit back and watch the sales roll in while you snooze. You're still awake? Then go to omnisend.com/ECC. Give OmniSend a try and start getting sales so steady they'll definitely put you to sleep. Don't forget to use code ECC30 for a 30% discount.
Okay, good morning, Blake. How are you?
Yeah, really well, thank you. How are you, Adam?
Yeah, very good, thank you. Now, Blake, I don't really like doing those kind of boring, crappy intros. So tell me, what is the absolute worst thing that you bought online recently?
Oh, it's got to be something I bought for my girlfriend about 2-3 weeks ago. She loves kimchi, so I went online and I found this big, massive bag of kimchi from a homemade supplier, and I bought it. When it came, it just exploded everywhere literally everywhere, all over the house. And I think to this day, there's still a smell of kimchi in the house. So yeah, it was good. It was good.
I mean, yeah, I like kimchi, but I think, kind of a home fragrance, maybe not the best thing, eh?
Yeah, we've been putting candles all over the place to try and get the smell out.
Love it. Now, Blake, I kind of want to kind of start off here by saying, look, you are not just there doling out cash to brands out of your own pocket. I mean, if you were, I'd be a lot friendly with you, but you are a broker, right? And before we get started, what actually does that mean?
So what a broker does is sit between two worlds, one which is the client and one which is the lender. The client requiring finance and the lender wanting to provide capital. In essence, what we do is we get down to the nitty-gritty details of every single business, understand the good, the bad, the ugly, where pain points are, where the good points are, and understand what their goals are right now and what they may be in the future. With that, then we collate all information, write a report up, and then we knock on the right doors. In essence, we work with nearly over 300 different people now, different lenders of all different types of financing. And when we don't just shotgun it to everyone, we don't just send a pitch deck and go, hey, are you interested in giving these guys money? No, we have a more curated approach. So how I can really summarize this is, if you require financing, going to us provides a more structured approach, but we only take on cases we know we can also provide them the funding that they need as well. So when we go from start to finish, it can take as little as 48 hours. Sometimes it can take a lot longer, but in essence, that's what we do.
Excellent. No, that's good to know, because I think, probably a lot of people on here, and myself included, I guess the first thought often is, when you're thinking about finance, what do? Well, you think about your personal life, you go to a bank and you ask the bank for money. And I guess that is a very much broad strokes approach, isn't it? And I guess what you're saying is here, there needs to be a little bit more analysis done about what you really need, rather than actually just taking the first, what appears to be the easiest option.
Well, to add on to that as well, I think anyone that's in business knows now that banks aren't really friendly to small businesses, especially, you know, since the financial crisis over nearly 20 years ago now. And the alternative financing sector has developed and blossomed quite beautifully since then. And in essence, you know, banks now just kind of do overdrafts and small business loans. But when you get to a certain size, or when you know, in the eCom world, you require a bit more bespoke funding for what their needs are. A simple overdraft doesn't cut it anymore. So yes, we typically, 99% of our clients are clients that are unhappy or cannot get what they require from traditional banking.
And I suppose the other question on this is, like, sort of from a starting point is, if you're an e-commerce brand sort of sitting there listening to this, is there a marker or kind of an indicator perhaps when financing goes from like, okay, it'd be nice to have, to kind of a must have?
Yeah, certainly. So I'll kind of break it down within, like, you know, the must have and the nice have. I'll start with must have first. So I would say a must have is where you are turning away orders, or you are getting opportunities which you just can't, you can't really, you know, your current cash flow does not allow you to take advantage of them. I think it also comes down, so I think it comes down to the lack of cash in the business and the operational cash flow you have. That's where must have happens. And also, I think it happens where, you know, you're ticking along quite nicely, but then, you know, unforeseen cash flow issues come out the drawer, an unforeseen tax bill, you know, someone, you know, an employee leaving and having to then recruit another person. This happens day to day in every single business. So I think that's where it's a must have. Where it's a nice have is where you're sitting back and you go, right, business is perfect. Everything, you know, everything's wonderful. What can I do to make things better? I.e., you know, so we're profitable, cash flow is great. How do I leverage my good business the best I can to potentially look at other avenues to potentially invest in or to grow the business?
Because I think, you know, the other thing on this too is, it's like, from an e-commerce founder's perspective, when obviously you've worked with obviously e-commerce brands that you have, do you sort of see any sort of telltale signs that sort of, you know, look, frankly, it's been held together with duct tape and hope, rather than having that capital to grow?
Yes, we see that quite a lot. And I think, you know, what I see quite a lot of is people, you know, founders say to themselves, the next deal will fix everything, or, you know, they delay key hires or delay stock orders or systems or operations that need to be put in place. They kind of put aside. You know, they constantly have a short-term kind of firefighting mentality with late payment, I'll take from Adam to pay Paul, or a lot of the times we also see them using personal credits or personal credit cards. And I think as well, when that happens, people then lose their way a little bit, and that then creates a bit of a spiral. I would say the majority of customers and clients that we work with are in that position, and rather than just getting them the finance we need, a lot of the times we sit them down and provide some kind of independent advice from, one, a lender's perspective, but two, from what I would say I would want to see from a business to grow as well. I would say, you know, from personally speaking, writing things down on a piece of paper, getting your thoughts on a piece of paper, and then writing a business plan, even if you're in a bad, sticky position or you're in a really good position, helps so much, because then it itemizes what's the most important thing right now today I need to sort out.
I mean, I think, you know, it seems to me like what you're describing as well here is that a lot of decisions making on finance, so, you know, can come from that sort of fear and that sort of situation that you're in, where you are just grabbing at that kind of, you know, the next thing. And I suppose, with your experience, Is there a kind of a big fear that e-commerce founders have about financing that in reality doesn't actually need to be a fear at all?
Certainly. I would say that I'm a big believer in being an expert in your niche. And I think when I speak to e-commerce founders, it's very clear that they are extremely experienced and knowledgeable about what they're doing, about their product, about their industry. And they can be then extremely successful in what they're doing. But I think when it comes to financing, they're not taught in school, these basic things, and during in life, you don't really learn about these things until you actually need it rather than want it. So a lot of what we do is educating as well. I think the main, the main kind of fears that founders have, it comes around more about, losing control of their business or getting locked into long-term contracts. And what we do as a broker is, again, sit down and understand what their goals are and clearly explain everything to do with a financing option. So, for example, the key things we always hear is, well, what if I have to give equity away? Or what does it mean if I give ownership away? Or what if I'm locked in and there's fees and hidden fees? And, we explain all that in a very clear and concise way, if it is or if it isn't. What we do and what we specialize in is debt financing. So very seldom, and I would say less than 1% of deals we do has any sort of equity involved in it. It's usually all debt. When it comes to getting locked in or fees, we itemize all the fees. And when it comes to getting locked in, we always try and provide facilities that have a flexible approach. So you're not locked in for 5 years, but we like to create facilities that grow with founders rather than get them stuck into one facility for the next 5 years.
And I suppose this is the thing here, isn't it? As well as that, I think particularly in the UK, financial education is pretty poor. And when I say pretty poor, I think it's absolutely terrible in honesty. Some people actually know that I, about 15 years ago, used to be a teacher. I used to teach economics and business. And there was no part of the curriculum where you dealt with personal finance. And I think what happens is that because of that, your personal finance skills are pretty poor, particularly in the UK. And off the back of that, then your business financing knowledge is even worse because you make assumptions, don't you, based on that poor level of personal finance knowledge you've got, unless you actually invest the time in speaking to the right people who know what's going on. And I think this is something we need to kind of tackle as a society, because it then makes people make bad decisions, doesn't it? Because they don't have that level of knowledge that they necessarily need. Certainly.
I would say that personal and business finances are very different, but then also they're very much the same. And what I would mean by that is, very, very often we come across businesses that are amazing, profitable, sky's the limit. But then the founders have got, from a year ago or 2 years ago, took a Wonga loan or something, and it's like, and just a little bit of education to go, you shouldn't have taken that, and how the ramifications can happen down the line. Certainly, I think as well, what we tend to see a lot of is, and this is just no fault of anyone's, but more about, and I think we're all at fault here. Certainly, I am, where you just don't know you need to know it until you need it. And so often, again, when I talk about the operational side of a business, so often we'll see a lot of businesses that are a victim of their own success. And what that means is they haven't put in the correct operations, the correct things in the background that will actually guide them to the growth they need to be. To give you a very quick example, we were working with a very small business that at the time was very small. They were doing about 400,000 in revenue, but they were a sole trader. They got this brand that they were building, and they just got 2 massive orders with some big blue chips for about £1 million. He didn't have the money to place to buy the goods, to sell the goods to these big blue chips. So he comes to us and he says, hey, I'd like the money to buy these, this security. And just because of his simple thing about being a sole trader and not having the accounts in order and not filing on time, and these little things put such a hamstring on that deal. In the end, we did get it across the line, but where the deal should have flown through, it took months and months and months more on the operational side than anything to get this deal through. So if I could teach anyone or explain to anyone anything, it would be don't put your future financing and growth to tomorrow. Have a think about, what do I need to do right now to make my company look as best as possible to future prospective lenders and investors.
That's great. I think actually we'll come back to that point, Blake, as well, because I want to dig into a little bit more later on. And I think for now, you mentioned obviously about debt financing, which you said is kind of like quite a significant part of what you do. Now, I guess, look, my knowledge of financing, I guess, is broadly around sort of three areas. You've got sort of obviously revenue-based financing. You've got obviously the equity financing you mentioned, and obviously debt financing. Let's imagine that each of those had a Tinder profile. Now, obviously, you've got a girlfriend, I've got a wife. We don't need Tinder. Hurrah. But I suppose looking at that, what kind of partner would they be looking for, or how would each of those be described if they were kind of putting themselves out there as three different options?
Certainly. So I'll go step by step. So debt financing is anything and everything to do with a 3-month loan all the way up to a 10-year loan for any specific reason that may be. That could be to buy assets, to buy property. It could be to buy stock. It could be for anything, marketing, recruitment, anything you have anything you could think of that there's a debt solution out there. Revenues-based financing is, as it's literally as the title suggests, it's based on your revenues. It's not necessarily based on profits or future profits or past profits. It's based on your revenue only and providing a facility based on that. And then equity, in essence, is selling a portion of your business for a lump sum of money to ultimately grow the business. Debt and revenue is for working capital. Equity is used mainly for growth. But debt is used for growth as well when a business is operational, revenue generating, profit making. I would always advise to people, for my own personal opinion, where you can, look at debt before equity, because your business is your baby. Like my business is my baby. And if I were to sell a chunk of my business, my baby, to someone, it's not about today's value, it's about tomorrow's value. And that's what I would always be looking at. So if I'm selling £100,000 of 10% of my business for £100,000, I'm not thinking about, well, that's today's value. I'm thinking, well, next year we were £10 million, and I'm giving away £1 million there. So that's how I would differentiate the both. Now, Tinder profiles, what would they say? They would say debt is for I can do anything and everything, whatever you've got, whatever your plans are, whatever your goals are. Revenue is, hey, I'm really growing, but I'm not profitable, but I need growth. I need money for growth. And equity is, I've got, I'm at a stage where the amount of money that I need surpasses a facility that I could get with debt. I.e., right. If you're looking for a huge amount of money, but you can't support that level of debt in your own business.
So I guess it's thinking, I guess, like you said there in the first instance, it's what is the purpose for the cash? And also what is the objective of the individual as the owner of this business, the implications of that, I guess, sort of driving, I guess, the overarching out of those three parts. I suppose with obviously businesses looking at each of these, are there any type of businesses or any sort of areas where you'd say, look, as a business, you should definitely not look at certain options and definitely look more towards others? Is there, it's probably quite hard to that, but are there any particular types where you say, look, yes, it's more this way you need to look rather than the other?
Certainly. So I would say every business is different. Genuinely, every business is different. Even if they were one-to-one, the same revenue, same profit, there's something different about that business. The way they pay their suppliers, or the way the founders, or the way the shareholders is made up, or there's 1,000,001 things that can be different that can change a deal. To get back to your point about, would I steer people in certain directions? I always want to get to the core reason as to why they're talking to me. And I do that by, my mentor many years ago told me about the way that Toyota goes about their business. And how Toyota goes about their business is asking why at least 5 times. So if someone comes to me and they say, I would like money, Blake, and I go, why? And they give me an answer, and I go, why? And they give me an answer. And I get to the core reason. And from there, I can then extrapolate, okay, now I know really what the real reason is here. And I can then go outwards and go, okay, so if that's the real reason, what can I provide, or what can I organize that will solve that problem and then allow you to grow? So hopefully that answers that.
No, definitely. And I mean, look, I know that tactic works because that's the tactic my 6-year-old uses on me most mornings, and she extracts every single piece of information out she needs from me. So yeah, I can see that definitely working. I suppose the other thing as well here is we spoke at the start there about, sort of people just kind of, putting their hands on the closest, nearest option. I suppose the other thing is when they do go wrong in selecting a finance option, are there any red flags that people need to watch out for?
Certainly. So I would say there's that metric, isn't there? As you can either have it quick, cheap, or fast. No, quick, cheap, or what I forgot what or good. And you can't have all three, right? So if it's fast, it's not going to be good or cheap. If it's good, it's not going to be cheap, et cetera, right? And I would say that what tends to happen with especially smaller, I would say sub 1 million-ish in revenue companies that are in this growth mode, that are figuring out how as they go along, they one day they wake up and they go, oh Christ, that bill came in larger than I assumed, or oh Christ, that person didn't pay me on time, and they're in like fight or flight mode, and they go to the easiest, quickest option first. And we see this so often, where what tends to happen is that option then hinders their ability for their growth 6 months or 12 months down the line. So often I'm having to untangle a situation because they just took it there and then. I would always say, having a chat with someone before you take anything is the best option. Now, a lot of the time, the quickest option is always the best option. But sometimes if you take a more of a, independent, clear approach, a kind of clear-minded approach, you will not have hurdles down the line. So many times, we've seen founders that are taking the wrong facilities. Most importantly, founders, for example, that are, who are in the retail space, for example, they're always wanting to buy more stock to sell stock and have, et cetera, and they'll take these long-term loans out, which, again, and I say to them, why did you take that? And it's, oh, because the installments were low. And it's like, no, I understand that, but you're now in a 5-year facility that is 1 year's paid off, and it's now hurting your ability to get your additional funding that you need for your next stage. So we see that all too often. And my one little piece of advice is to sit back and go, well, that's obviously quick and simple. Is it the right option for me at this time? And the question should always be, how will that affect me in the future? How does that affect you in the future? That's the question I always ask myself when putting a deal across to someone, is how would this affect, good or bad, for this business?
So basically, pump the brakes before you make a decision. Get some information first, I think, is the overall message, really, isn't it? And I think the other thing is you mentioned this earlier on about sort of getting your house in order. And I want to kind of move on to that about sort of thinking about getting ready for finance. So I know, let's say, for example, we've got, a sports nutrition brand and they're thinking about financing to get growth, for example. So what should their financial house look like, or should it look a certain way before they jump into that?
Sure. I would first be asking questions, and I would understand, so where are they when it comes to revenue? Where are they when it comes to profit? Where are they in the whole kind of scheme of things? How do they pay suppliers? How do they, who do they sell to? What does that makeup look like? What do their margins look like? I would first have to understand the case in more detail. But the guideline, really simple as, having accounts on time. That's what we always need to see. Having everyone has to have an online account, a cloud accountancy platform software. Having that up to date as much as possible, so we can see where you're at to right now, day to day, what's your sales looking like. Being on top of the simple things like tax liabilities. So often we see really, really successful businesses get into time to pay arrangements with HMRC. That kills businesses, and it really kills it because, I don't want to go off on a different subject here, but we see it so often where they think it's like, spreading their car insurance, but it's not. It's a debt management facility. You have to default on that debt, on that liability, before you can spread it. And so often we see such amazing businesses, unfortunately, not being able to obtain the right finance because, again, 3 months ago, they thought it'd be great just to help out with cash or just to spread it. Now, there are finance options to do that. And I would always advise companies to look at those options to fund a tax bill rather than get into a time to pay, just because from a lender's perspective, they would ultimately view it as good cash flow mitigation practices rather than, oh, we've defaulted, now I need to go to HMRC. Little things like that, being on top of your tax is really important, but making sure your accounts are filed and all your kind of books are up to date. Now, separately, I would also say that from a personal standpoint, having people have this illusion that business finance is business finance and it's not integrated with personal at all. And it's correct. Business finance is business finance. But a lender takes a holistic approach on a deal, right? And so they may have a cracking company, but I gave the example of a chap that took a Wonga loan out maybe 2 years ago or a year ago. They're going to look at that chap and go, right, well, you've got a cracking company, but personally, you're a bit all over the place. You're 3 months behind on your mortgage, or you're taking that credit card debt and you've got Klarna up the wazoo. What type of person are you? And they do ask those questions. They go, because ultimately they're making a bet on your company. And, they do make it an opinion where they say, well, if you're terrible in your personal finance, why would you be any different in your business finance? And they do make that assumption. So I would also say as well, if you can, try and have as clean as a personal record as possible. It doesn't have to be squeaky clean. I know founders don't have squeaky clean things. It doesn't have to be perfect, but ideally no CCJs. Before it gets to a CCJ, don't let it be a CCJ. Or, if you have taken out a Wonga loan in the past, well, give me some reason as to why that was the case, and hopefully we can mitigate that. Also, and I'll finalize with this, if you're in a position to buy a house as soon as you possibly can. We still live in a bit of an archaic society where we have amazing companies that are able to obtain the right type of financing, because certain lenders have to do a tick box exercise in the beginning. If you're not a homeowner, you sometimes aren't able to get those simple, those best facilities. I can give you an example of a guy that owns a string of retail stores. He does in excess of 7-8 million a year in revenue, profit about 500,000, and we are unable to obtain the best deals for him simply because he doesn't want to own property. He's one of those people that's like, I don't want to own property. I'm happy not owning property. And I said, if just buy a house, just buy a flat anywhere, and then you'll be able to just tick that box, and we'll be able to get you so much more at better rates. But little things like that.
Yeah, because I suppose, on that note as well, I mean, I guess there are also things that you can do to kind of clean up your credit score, isn't there? And there's lots of companies out there that sort of promote these kind of services. But I guess, again, it's also, can you mitigate that, like you said there, about making those decisions earlier on, maybe if you're not quite ready for finance, and understanding the case. And I think, look, this is definitely something that I learned, is that, look, you have this perception, when you own a limited company, that look, the company is a separate entity to me as an individual. But as you then find out when you go and speak to financial institutions, they do obviously then do that deep dive into you as an individual as well. And I think it's something, that you don't necessarily assume, if you've been through the kind of the business school route that, sort of I have and others have. Now I'll getting on to business school and kind of talking about this. Look, LinkedIn. There's a lot of bullshit on LinkedIn, let's face it. And look, I think there's some good stuff and there's some bad stuff. What I'm interested in though is there I suppose, LinkedIn versus real life version of what founders actually have to present to financiers?
Yeah, certainly there is. Being a broker means, as I said, I sit between two worlds, right? So in real life, what you see on LinkedIn is we're disrupting the industry. We have triple-digit growth year on year, oversubscribed founding runs. We've got hundreds and hundreds of clients that are itching to get on board. The sky's the limit. And then when it hits your email and you dive into the numbers, what you actually see is, we've burned through all our money. Margins are tight. Suppliers want to get paid now. We've got a VAT bill due next month. We haven't got we've spent that money to buy stock. Sales are up and down. They're not as, as streamlined as we hope. And, our marketing director just quit. We see that we see that all the time. And that's like the real kind of story. Now, what founders present to us and to lenders isn't lies, it's just selective framing. And our job, or my job, is to cut through that and ask, what's actually happening? Is this growth sustainable? What's a smoke and what actually is real? And what's going on today, and figuring out more of the details. And I do storytelling. I have to frame this as well. I mention this all the time. What we do as a broker is frame, because we work for the client, is frame their company in the best possible way within a language which lenders want to see. So they do want to see the good, the bad, and the ugly. Lenders understand that there's ultimately going to be a lot of bad with a lot of good. They're not daft. And I think the key thing that I always have to walk through with founders is, there is a lot of bad, but there's also a lot of good. So what do we need? How do we frame the bad and turn it into good? So if there is bad, what are we doing to make that into good? What are we doing to make that better? And I'm going to give the example again with tax liabilities. Because it's very, 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 I see it a lot all the time. You see founders that are who are seasonal, for example, have a very, especially with Amazon or retail, Christmas is their busiest time. And so often it's their busiest time going into their worst time, January, February, right? And we see a lot of financing requirements in that January, February, March time, because the story was, we had an amazing Christmas, but now I can't, I've gone and bought all my, I've gone and spent all the money and I can't afford to pay my VAT. Again, that's the ugly. I can't afford to pay my VAT. But the good is, but don't worry, Mr. Lender. We're going to get a loan from you to cover that VAT bill over the quarter, because we know that by doing X, Y, Z, injecting into capital, doing X, Y, Z, and whatever interest you're going to charge me is negligible, because we're going to do X, Y, Z, and it's going to ultimately be beneficial for our business. That is the crux, really.
And I think, on sort of pushing it forward a little bit more is thinking about, I guess, some of the questions that founders probably want to know as well, is that if you're kind of thinking about, look, how much runway should a founder aim for? And I guess, look, what does runway really mean when you are scaling fast and you are burning cash?
I think if you're scaling fast, you shouldn't have one runway, right? In the sense, because you're spending money for future growth. I think what I would say though is so often we see companies that again who have burnt through their runway and are coming to us when they have 30 days left. And my argument has always been, well, why didn't you come to me when you had 12 months of runway? And that is why I get angry at them, because I say, you come to me when you need it, and you should come to me when you want it. And there is that old saying, banks lend money when you don't need it. And I would always argue that if you're in a position to not need it, then you should be looking at what options are there to have a big war chest. Again, so many, I would say that, I've worked with companies that have gone from 10,000 a month in revenue going up to 1 million, sometimes even 10 million a month in revenue. I've seen those success stories. And during that whole process with working with them, the key thing that they've learned is if someone's giving me the money and it makes sense, I'm going to take it. Because one, I'm building a relationship with that lender. Two, I'm building a bit of a rapport, a credit report. But three, I should be using other people's money, and I'll utilize my own money for the other things that will potentially provide growth. To give you a very quick example of how that may work in a real life scenario, imagining you have a great product that's ticking along very nicely, and you want to invest in a new product that you don't know anything about yet. The market's not quite secure yet. Leverage your existing product, utilize other people's money for that, and then utilize your own money for the potential growth. That is also a way to look at things. And that is how the difference between companies that stagnate and companies that do go through the roof as well. A lot of founders as well, I think, naively think that equity is the solution to all their problems. I don't know if you've gone through an equity round. I've not gone through an equity round personally, but I work with companies that have gone through lots of equity rounds. And I can tell you, they're not 48 hours. They're not, they can be up to 6 months. And if you're waiting for 6 months for a bit of money to come in, what opportunities are you missing? How does the company look like in 6 months' time? So often, in fact, I actually get calls from companies where equity houses fall through. And they go, we were waiting for this money to come through, and it's now not come through. And what's my options? And I go, well, maybe you should have come to me 6 months ago. And that happens quite often.
Yeah, I mean, I think, look, there's a couple of things there I sort of pick up on. I think, look, people that I know who have gone down the equity route, I think it's like you mentioned there, the time factor is definitely something that they spoke to me about. I think the other thing is, the other side of that is that when they have given a guy equity, is actually living the ramifications of what that means in certain deals and the stipulations for running the business, the reporting, the processes that are used. And I think that's been something that business owners that I know have sort of felt quite bitter about, because they've gone into a deal where they haven't really understood the full implications on a day-to-day perspective of them still then being part of a business that they once they're obviously the sole proprietor of. And I think, look, the point you made there about kind of, when you don't need cash per se, I think, look, it's a pretty sound thing to have in mind for business in general. I think it applies to a lot of things. So, for example, like with hiring, yes, you might not need a hire now, but keep having those conversations with people who might then be looking in 6 months' time. If there is a supplier that isn't right for you now, have that relationship starting so that when it does come to that point, you've kind of got an easier route in rather than rushing and being able to assess all your options. And I think, look, it's hard, isn't it? Because look, the day-to-day of running the business, it can get on top of you, and what's at the end of your nose becomes more important. But if you can set aside that time to do it and say, well, look, actually, let's just take a step back for a minute. It stops you with kind of those gun to the head moments where I guess people are coming going, look, shit, we've got 30 days left. What the hell do we do? Because I guess the options that you then are presenting to them are, a lot more limited than what they would have been.
Yeah, absolutely. It's always the case. And I can't fault founders because we're all, because they're learning as they go along.
Yeah.
But I think, adding to your point about the equity side, and I mentioned about selling a piece of your baby, but I think you're absolutely right. You're also adding a person into your company that, well, one is not adding because they want, they're not giving you, let's say, 100 grand just because they like you. They want it because they want you to turn that into £1 million or 10 million quid or whatever it may be. And they want to professionalize you. And sometimes it's hard for founders to get told. I mean, I'm a founder, you're a founder. We hate it when people go, you need to do this. And I go, well, hang on, I know best. And it happens all the time. I mean, even when I say it to people, people come to me, I want you to get me money. And I go, well, I think you need to do this. And they go, how dare you, Blake? And I'm like, well, I'm trying to help you here. It happens all the time.
No, absolutely. I mean, I think, on going back to the financial side of it, we've got the cost of capital, I guess, from that financial point of view. But are there any sort of, I guess, hidden costs that founders sometimes only maybe discover after taking the money?
Yeah, there are. And as a brokerage, we're very, very, very big on transparency. So whenever we provide or organize a funding facility, we will present the client with what's known as a terms of business. And in that terms of business, it outlines literally everything about that deal. Any fees, any costs, exit fees, anything and everything you can think about. Now, where founders will always, where founders do get a little bit caught up is they forget the difference between variable or flexible and fixed. So a lot of the time in the business world, a lot of lenders are fixed term. And when people hear fixed, they go, oh, it's like a fixed term mortgage and it's there for 2 years. And no. What that actually means is that all the interest is front loaded. So if you take £100,000 out and it's 10% per year over 5 years, it's 50 grand. And and in 6 months' time, you took the money, you invested it, and now you don't need that 100 grand anymore. I want to pay that back. And people go, I'll just pay that 100 grand back. It's just, no, you've got to pay everything back. So people do, unfortunately, get stuck into these facilities where they go, oh my God, I didn't know that. Well, yeah, because, you didn't read the fine print. Other things like variable, so we do, in normal SME funding, variable isn't a big thing, but it's big in property, for example. And we do a lot of property loans. But variable, people take out variable loans and they go, especially during when interest rates were so low. You know, there was a time when interest rates were 0.25 and interest rates were like 1-2%. And they said, oh, I'll just take a variable, it's 2% above base. I'm seeing deals now where people are having to pay 2, 3, 4, 5 above base when it's now, 4.25, and they go, I can't afford this, and I go, yeah, little things like that. And then one last thing as well is when people take asset finance out. So people might be thinking, well, what's asset finance? That's got nothing to do with, eCom. Actually, again, it comes down to what type of business you are. So we work with, for example, lots of different people, but we work with, let's say a gin brand or people that make beer. They may want to buy like a gin distillery piece of equipment, or they may want to buy packaging machinery. People will buy that and then they'll go, I didn't know that I had to pay this monthly fee, an operational fee. I didn't know I had to buy, when I completed the deal, I didn't know I gave it back to the lender. Like little things that people forget. I do come across it quite often where someone bought a big piece of machinery and they didn't know what the difference between a finance lease was and a hire purchase was. They just looked at the number on them per month. And then after 3 years, when they thought, oh, it's my machine, the lender was like, no, can I have that back, please? Because you signed this agreement that says it's actually mine at the end of it. Oh, and if you want it, you got to pay me this money. See, all the time. So those little things do make a big difference.
Yeah. And I think, this is the thing. It's like people listen to now that, they're probably going, well, yeah, obviously, you'd read the information, but we've all been guilty of that. And in the heat of the moment, when you've got, 25 other things to do, you need that advice to be able to say, look, actually, this is the stipulations of what you are letting yourself in for and what is going to happen. And I think that's the problem, isn't it? When you kind of tend to do this alone, there are all these things that you wouldn't necessarily pick up. And I think, you mentioned there, about kind of things that people forget about. On kind of the cash flow side, are there any kind of, I guess, sort of like cash flow killers that founders don't tend to spot until it's too late that you often see?
Yes. The number one cash flow killers, and again, I've mentioned it a number of times, is tax. It's always tax. It's always corporation tax. It's always self-assessment. It's always payroll, PAYE. It's always VAT. That's always the case. And it's because if you haven't, everyone moans about their accountant. I moan about my accountant. They get the VAT bill sometimes a day before it's due, right? Or 3 days before it's due. And in their head, they've gone, it's only going to be 10 grand this quarter, and bam, it's a 40 grand bill. And you go, why is it 40,000? Well, because of X, Y, Z. And you go, oh my God, I can't pay my VAT and I can't pay payroll. Happens all the time. That is a secret killer. I would also say as well, that's the main number one killer. I think as well, it comes down, there's that saying, isn't there? Hiring slow, hiring slow, firing fast.
Yep.
And I see that a lot in small businesses where, as a business owner myself, I can tell you that to find the right person, you can sometimes go through 5-6 people. And that process is very laborious and it's very, very expensive. And people forget how expensive it can be. And that is a number killer as well. Again, hiring and firing is a big, big killer. I've had clients come to me where they've gone, I have to get rid of my marketing guy. My marketing director is terrible. And in his contract, they've got to give me a year upfront salary, and it's like, well, you've got to give this guy like 70 grand or something, and I haven't got it. Little things like that are silent killers. But I think the number one is certainly tax. And I would say whenever someone comes to me, they go, hey, I'd like £100,000 or I'd like 500,000, whatever it may be. When I dig down to it, it's always that reason that's always a big sticking point for them in any business. If it's a £10,000 a month business or a £10 million a month business, it's usually like one of the main reasons.
Yeah, sure. I mean, I think what I was going to say as well is, look, I always find that when the subject of finance comes up, and I think even with some of the questions that I've sort of asked you today, there's almost this perception that cash and injecting finance in a business is actually all about growth. And I think, the point about survival here, what about that? And I think the other side of it is, are there any kind of forms of finance when you are more in survival mode that maybe seem a little bit less sexy than the stuff that's there, but are probably more important when you are in survival mode than growth?
Yes. So when you're in survival mode, obviously a lender knows that. And because they can see it. And I think, again, it kind of gets down to the core reasons as to why you're in that survival mode. So again, my whole reason of why. So a lot of businesses come to me when they're in the survival mode, again, purely because they've got themselves into a pickle and I have to untangle it for them. And sometimes it can be purely operational, and sometimes it is down to just cash flow. Now, if you're a business where, all of a sudden, some brand is ripped off your product and all of a sudden your sales have gone from X to, 100 to 0, sorry, but I can't help you. What do you do? From an operational standpoint, what are you doing to get it back to 100? I can't. No short-term financing is going to help you get that back, right? But if it's purely like I'm in a survival mode, I have to really get down to the question as to why. And 9 times out of 10, it's more of a founder's perception and outlook and their own reasoning, and I have to kind of explain to them what we can do on the finance side, but what they need to do on their end as well. I'll give you an analogy. If someone comes to me for an amount of money and they get it approved and they're all happy, and that money lands in your bank, I don't have anything. I can't run your business, and I'm not running your business. It's up to you to make that what it is, to do the growth. And if you're not capable of it or you can't do it correctly, that's on you. But I see so many survival things just because of operations. So many because they've always had a bookkeeper, and now the bookkeeper just can't do what they need to do. Simple little things like, and I'll give you one example of a company that went from, again, nothing to massive. They had a £360,000 corporation tax bill. That's a massive bill to pay. And he was buying this huge asset, a part of their business. And if he had just bought it 3 weeks prior, he would have negated that against his corporation tax bill and paid 0. But because he bought it 3 weeks later, it was then on this month's corporation tax bill. We had to pay that 360. You see what I'm saying? Like little things like that, where again, it's like ascertaining why you're in survival mode, and more a business. This is where the difference with personal and business is very different. And this is why we're not a comparison website like you can get. You can see these like loan comparison websites, because so often the core is you, and I have to then explain, talk to you and understand how you may be the problem and what you can do in that place. And if I'm being brutally honest with you, people appreciate it. They love it, and it's sometimes it's a bitter pill to swallow, but they do appreciate it and they listen, and that's why they come back to Finspire, because we kind of act as their right hand man when it comes to these things. Every day I get a phone call, Blake, I'm thinking about doing this and this. What do you think? It's not my role to tell them what they shouldn't do. I personally come about it from a finance perspective, like, hey, if you want to do that, we can look at this and this option. This is how much it will cost, and this is how it would help you. But ultimately, it's down to him if he wants to do it. And I would tell you right now, I tell people not to take things more than I tell them to take things. I will work on a case, spend 4 days working on a case, get them the money they want, and I'll go, actually, it's the amount of money that you want, but this is not going to be good for you, and I don't think you should take it. I'm gonna make, if you want to take it, it's up to you if you want to take it, but I would say don't. And people sometimes do, and they sometimes don't. It's up to them,
But I guess that's the thing. Like, there's obviously you will have fees involved in the deals you have, but ultimately, it doesn't make sense for you to be putting things in front of people that aren't going to work, because I guess, look, number one, you want them to come back again when they want to raise more. And secondly, you want that sort of positive reputation through word of mouth that then gets you recommended. So, I suppose that's, I guess, the beauty of it, isn't it? The carrot is there for you to try and find those things that are going to work best for them and going to work out. And I think, look, like this is a great chat. And I think what I was going to say is I've got a few more questions for you. We've had a couple of questions already in the chat, guys. So if you do have some more questions with Blake, pop them into the comments, and then we'll bring those up when we go into the Q&A after I'll ask you questions. So I think on that note, Blake, like looking ahead then, now, I guess in ecom, we love to talk about the market and obviously what's happening right now, the impacts, but thinking about maybe the cost and the process of finance, sort of now versus last year, is it more expensive, less expensive, about the same? And I suppose the other thing is, anyone sitting there now going, well, look, should we go now or should we start looking into this next year? Is there anything happening in the market that makes you say now versus later? I'm just kind of curious about that sort of situation, about how things stack up.
Sure. The day-to-day business Bank of England kind of base rate that everyone kind of looks at isn't typical for about 90% of the lending market. It isn't reflected. So if the rate goes down 0.25 or 0.3, yes, that helps your personal mortgage, and yes, that does help property stuff, but it doesn't really help the more of the bespoke financing products that we provide, eCom. It doesn't at all, because how lenders tend to operate is they'll tend to buy money in via bonds or via coupons at a certain rate. Let's say that rate might be 5%, and they'll lend out a specific rate. And that's how they place their business. At the end of the day, all lending is buying it at one price, selling it at another, right? And so I would say do not say to yourself, oh, Bank of England's going to go down 0.25 next month. I'm going to wait 3 months. That is farcical. Okay, let's say it does affect your interest rate. It goes from 10 to 9.75. You're going to save 100 quid a month. Is that? Are you really, pausing your growth plans for 100 quid a month saving in interest? That makes no sense to me, right? So I would always say, I don't believe in tomorrow. I believe in now. Have a look into it now. Have a look at your options now. And very often I will say to people, you're not ready. Come back to me in 3 months' time or 6 months' time. Come back to me once you've done this, done that. Because if you waited 6 months to come to me, I might give you the exact same advice because you haven't listened, because you didn't come 6 months earlier and I didn't tell you what you needed to do to make it look better. We do have so often clients come to us and I get them finance and they go, maybe you should wait 3 months and do this and this, and we'll get you a better offer in 3 months' time. And that happens more often than not.
Because I suppose the other thing is on those sort of perceptions, and like you said there, particularly, with the base rate. I mean, like you said, I wouldn't say I'm a finance buffin, but I definitely I've got an interest in economics and the kind of situation, and I think that is always one of the biggest myths, isn't it, about looking at the base rate, and then people then go to the high street banks, for example, and say, well, hang on a minute, what's going on here? There isn't any massive reflection. I think on that note, are there any myths around financing e-commerce brands that you wish would kind of die?
I think one of the myths are, lenders don't like e-com. Lenders love e-com. I think one of the myths are, lenders won't lend to me because I'm not profitable. Lenders will lend to you if you're not profitable, if you've got a really good runway and you've got good cash flows and a good business plan. I think it's one of the myths are, I have a CCJ. Well, if it's paid off and there's a reason, we can do that. Or, I'm not a homeowner. No, we can do that. Or other things like they won't do it. They won't do it the interest rate I want. Well, you don't know that. Or they're all money hungry loan sharks, and they're all out for themselves. No, a lender wants to work with you and wants you to repay their loan back and come back to you, and they want to have that reciprocal relationship. I think as well. Again, people know their personal finances. They know that they can get mortgages, they know they can get credit cards, and they can get overdrafts. The world of business finance is so much more than that, with so much more bespoke niche products for e-com that you'd be astounded how many are out there and what we can do. We can leverage and again, it comes down to what type of e-com business are you? How much of your business, for example, is wholesale and retail? How much of it is, all these type of different things? And I sometimes come back with 4 different facilities that we're going to put in one place for one client. Happens all the time. People just think, oh, I just need a loan. I'm just going to get a loan for 12 months at 100 grand, pay back that, and that's it. Yeah, that's one way, and there's other ways as well. There's so many things out there, and this is why you need to talk to us, because one thing may be good for one person. You could have the exact same company, but one thing might be great for one company and one thing will be great for another company, that same company.
Excellent. And I suppose, look, my last question is, look, let's say, for example, you've got a founder listening and now they've never taken funding before, maybe, and perhaps they're looking to, expand internationally. What should, I guess, the next, let's say, 90 days look like for them in terms of getting ready for that process?
So if your question is asking, they want funding to expand internationally, the first thing that, as I mentioned at the start of the call, is write your plans down on a piece of paper, because then the idea then becomes real. And when you're expanding internationally, there is debt funding for growth. No, of course there is. The lender really is lending against previous kind of financials, and you're then saying to them, I need all this money for my future. And you really have, and my job is to read your business plan, or even to a point, read your emails and create a business plan for you, is what we do a lot of the time, and create cash flows, and then tell to a lender this, he's going to the international market and here's why. It's not just because I want to go to the international market. I want to know, why are you doing that? What is it going to do for your business? And, what are the pitfalls? What's the good, the bad, and the ugly? And really, is it because people are saying you want to go there? And, what they should be preparing is a business plan, cash. That's the first thing they need, really, is tell me why you want this and why you're doing it. A cash flow forecast. And I want to know on that business plan, operationally, well, you're going into America or you're going internationally. Does that mean you're going to have operations there? You're going to have a warehouse there? Or you're going to have a manager there? You're going to have sales staff there? What does that look like? And, if you go into America, they're like 5 hours, behind us. So let's just say you have your own brand and you're going to, you've got on Shopify, you're going to start selling to America. What happens about customer service? All these little things I want to know about, the lender's going to want to know about. And actually, at that point, the lender really is ascertaining, you can have a stellar business, but the lender may decline you because they go, we don't think he can do it. We're not going to give him our money because we don't think he's going to do it, because the business plan he's provided is childish. It needs to look proper.
Yeah. I think that's great advice. And I think, I would imagine a lot of people as well, listening again, maybe wouldn't assume that, these lenders would be looking into the intricacies of actually how you're going to, and then making that call about whether you can do it or not. Because again, I think the perception out there is that it's a purely from an affordability point of view, and they're looking at those financials alone. And like you said here, that just isn't the case. But Blake, look, this has been fantastic. We've actually got some questions I want to run through. So Lee Cash, with a very apt name, says, what is the minimum level of funding you provide? And then he goes on to say, or rather funding support, I guess I should say.
Minimum we can do right now is as low as £5,000.
Mm-hmm.
And we can go all the way up to 100 million.
Great, thank you.
Yeah, the smallest loan we've done is 5,000. The largest loan we've done is 7 million so far.
Excellent. And would you say, in terms of the appeal to lending to different e-commerce businesses, I think I'll probably announce this, but are there any kind of verticals or industries where there is more appeal for finances to get involved in the others, or does it really depend upon the individual intricacies of that particular business and their setup?
I think every sector has requirements that are different to each individual sector has different requirements for financing. So, for example, I would never talk about stock funding to a guy that's in construction. It would make no sense to him. But I would certainly talk about financing lorries and hard assets and machinery. But I wouldn't go and talk to a guy that's selling, plastic bottles on Amazon. Hey, do you need a digger? Do you need finance for a digger? Like, it's just two different worlds. But every industry has their own bespoke, financing products. And in eCom specifically, there are a lot of unsecured products surrounded by cash flow and growth, mainly to buy and sell stock. But also, again, we see a lot of inquiries for, hey, I need money for a marketing campaign or hires. Or even I want to do a vertical integration. I want to take away. I want to stop paying my packaging company. And I want to bring it in house. That type of stuff. We see all that type of stuff all the time.
And is there anything that maybe you've seen that e-commerce founders have asked for funding for that tend to be look, that's just not going to fly? Are there any particular projects or type of projects that don't tend to fly?
Yeah, we do a lot. I've seen things like, hey, I want I want to get I want to get one of those electric windmills in the back of my, I work from home and I package from home, and I would like to buy a £200,000 Siemens windmill so that I don't pay, so that my bills go down to zero, and then I can start selling to the grid. And the bit is fine because the business will pay for it and the business can afford it. And I'm going, no, that's not going to work because you work
It's going to take about 40 years to recoup the investment.
Yeah, exactly. Yeah. I've seen those things, and I've seen things like, oh, I'd like to buy an Audi R8 to take my clients around. I need an Audi R8 for my business. Don't worry, I'll put my business logo on the R8, but when I pick up clients, they need to see I'm driving an Audi R8. Okay, well, maybe, maybe, I've seen those things, it happens.
Oh man, I love it. Well, look, Blake, honestly, absolute pleasure to have you. And I know that people will be loving this one because, again, it's not a topic that we cover a lot on e-commerce. We tend to focus on, and like I actually said at the eCom Collab Club yesterday, we tend to focus a lot on the shiny front end marketing bits, but actually it's the back end, the operational side of the business that really is going to make the difference longer term. So if people obviously want to find out more about you, get in touch, what should they do? Where should they go?
We have a website, which is finspirefinance.com. All our details on there, all what we do, all our loan products are on there. If you fill out the form on there, it'll go straight to us and we'll reach out to you and have a 30-minute session to understand where you are and how we can help.
Fantastic. Blake, thank you so much. Really appreciate you coming on, and I'll see you very soon.
Thank you for having me on. Look forward to it. Thanks a lot.
Cheers, Blake. Bye now. And guys, thank you so much for joining today. And if you are listening as well on Spotify or indeed Apple Music as well, do give us a like or a share from wherever you're listening. We'll be here again next week with Peter and myself, the next episode of the eCom Collab Club podcast. Cheers.
Thanks for listening to the eCom Collab Club podcast. Make sure you like, subscribe, and join our community at ecomcollabclub.com/community.